I just have to read it. So I'm gonna send it a little more this way. But yeah, the whole, it's like totally.
Little less shot.
You can't see that.
More off, that's not good.
That's the only thing that's happening.
Cool. So is she gonna shut the door when we're
You can go live, yeah, you can start, she's just making sure everything's working.
Okay, you're live. All right, we will call this to order. And we will begin with an opening prayer, Mr. Hammond.
Thank you. Please join me to sign the cross in the Father, Son, and Holy Spirit. Amen. Holy Mary, you are at the heart of our Catholic school division. Through our consecration to Jesus, through your Immaculate Heart, we entrust every decision, every challenge, and every success to your gentle care. As we begin this meeting, remind us that we serve not by our own strength, but under your mantle and your intercession. Teach us to listen well, to collaborate with humility, and to lead with love, wisdom, and truth of your Son. We ask your continued patronage over our schools, our board, and all those entrusted to our care. Guide us always closer to Jesus. Amen.
Thank you. Dr. Zarichny?
Before we begin, the Medicine Hat Catholic Board of Education would like to acknowledge that we are gathering on the traditional lands of the Blackfoot people, who have welcomed here for centuries the Cree, the Métis, other First Nations and non-Indigenous people. The land is now recognized as the traditional territory of Treaty 7 in the north, west, and south, and Treaty 4 to the east. Medicine Hat Catholic Board of Education also wishes to thank the First Nations people, past and present, for welcoming us here.
Thank you. So approval of the agenda? Anybody would like to move that?
I'll move, Chair.
Mr. Finch, all in favor? Okay, number 5, audited financial statements.
Thank you. So we are here today to talk about the 24-25 audited financial statement. Amanda, who has done all the work on this, will be presenting an update in terms of the financial statement and provide some analysis of what has transpired. The audit committee met on November 24th to review the audited financial statement, as well as to meet with the board's auditor, which is MNP. And they've reviewed those documents, and after their meeting, they've come up with a recommendation for the Board of Trustees that the Board of Trustees approve the 24-25 audited financial statements and notes to the financial statements, along with the transfers to reserves as presented. So that will form the basis of the motion that we will be asking for at the end of this meeting. So I'm going to turn this over at this point to Amanda, who will walk us through the audited financial statement, as well as provide an analysis of what is undergone.
All right, well, thank you. So today's presentation isn't different from what we've seen before. A lot of the information within it, you would have been provided during quarterly updates throughout the year. I do recognize that some of the faces around the table are new and others old, and Mr. Rubin, that's not anything to do with age, that's just familiarity. But the other former.
Form is a good one.
Yes. But so where there's reference to previous reports, I'll try to provide that background. And while you have all of the information in the agenda as links, so the audit financial statements and that, you don't really need to follow along with your package. I've tried to make the presentation so that you're able to follow along on the screen. But for sure, if you have any questions along the way, let me know. And there's also a time at the end for questions as well. There are, again, several numbers in front of you. I'll be running through 3 or 4 of the main statements that I feel are important. There's some key information within them, some accounting concepts that I want to make sure you're aware of and how they go. And then at the end, we'll look at how that all ties together in terms of our financial outlook. So our financial statements are prepared using PSAS guidelines, which is similar for other schools, universities, colleges, and hospitals. So it just means that we have a consistent layout to our financials, but that they don't look like any other business financials that you receive. So they're laid out a little bit differently. So the first statement that we're looking at is on page 4, and it's called our statement of financial position, typically referred to as a balance sheet. And it's divided between our financial assets and liabilities and non-financial assets and liabilities. Financial just meaning can we easily convert it to cash. And so our first balance there is our cash balance with $4,637,000, which is a decrease from last year of $358,000. And essentially all of the lines below it will tie into why it has decreased from last year. So as we have an increase in our accounts receivable, that means that at the end of the year, there were fewer vendors that had paid us, that we were still waiting on that cash to flow into our bank account. And just similarly, we can see an increase in accounts payable, which means that we had also sent less money out of our bank account, and so that would impact that final cash number as well. Our second line is accounts receivable with the balance of $1,533,000, which is an increase of $235,000 from last year. There's two main balances within this line. The first being $1 million, just over $1 million being due from municipalities. So with our property taxes, there's an education component to it, and those education property tax dollars are funneled into a fund called the ASFF, or Alberta School Foundation Fund. And then on a per student basis, they're allocated back to school divisions. And so as a separate school board, we've opted out of that ASFF fund, meaning that we collect that revenue directly from the municipalities. So it would either come directly from Alberta Education, or we would get from the municipalities, and that's where we're grabbing ours from. And so at year end, there was just over $1 million left as receivable. And so that's kind of a concept that you're going to hear repeated throughout today's presentation. It impacts a few more of the line items within the statements, so we'll just hold on to that one too. There's also a balance from Alberta Education to the amount of $230,000. So in January of each year, we provide a projection on our enrollment, and they go ahead and calculate our grants based on that projection. And then come September 30th, they look at what our actual enrollment is and recalculate those grants. And so based on our change in enrollment, we actually had an increase in funding of $230,000. So that receivable will be there. We record that as a receivable at year end, but now over the 25-26 school year, we actually receive the cash. Just below this is our liabilities, or those amounts that we owe others. And so accounts payable is the first line there at $3,150,000. And there's three main larger balances that make up this figure. The first being $964,000 due to Alberta Ed. So if we go back to the ASFF fund, every dollar that we receive from the municipalities, we are then sending back that same dollar to Alberta Education, because they provide us with their grant funding as an envelope when they send out their deposit. And so included in that are some of those grants that are funded through the ASFF. So there's also $428,000 that relates to the federal government from our last payroll run of August. So that's the receipt of general tax that we owe. And then unearned revenue accounts for $1,152,000. So typically in May, we start charging students for, say, academy fees for the upcoming school year or international ed fees. They're required to pay full before they arrive, but because that's not for the current school year, we don't record it as revenue until the year that it relates to. Below that is unspent deferred contributions at $2,033,000, which is an increase of $165,000 from last year. So this represents the grants that we receive where they're very intentional on how we have to spend it. Usually it relates to capital or buildings. So our IMR balance within here is $782,000 and CMR is $569,000. But there are some operational grants within there where we're required to spend them in a certain way. And that would include the collegiate funding. So that first responder academy at McCoy, we had $349,000 that we received before the start of the school year. So we record it there, and then as we incur those expenses, we would move it into revenue. Lastly, we have our asset retirement obligation line, or ARO, at $1,027,000. This represents an amount that we'll have to pay later on. Our buildings, a lot of them were constructed before 1994 and include hazardous materials, typically asbestos. And so before we dispose of those buildings, we'll have to remediate the asbestos. And in order to do so, cumulatively, it would cost $1,027,000. It's not really a cash out that we will ever have to fork the money out for. It's typically included in the funding when we have a new school built. So if we look at St. Francis being demolished within the next couple of years here, the funding to get rid of that asbestos is included in the funding that we're receiving through Alberta Infrastructure, Alberta Ed. But it does represent a cost that will be incurred. We're also making sure that over the next couple of years that we relook at what that value is. And so we'll have a good metric when we do demolish St. Francis as to whether or not the estimate that we've received from a third party, how accurate it was, and be able to adjust this figure too. At the end of this section is our net financial asset or debt line, and you can see here that we're in a negative balance of $40,579. So typically, this isn't used as a temperature check on your financial situation to know whether or not you're in good working order or not. It's looking at the financial assets, looking at and then deducting the liabilities. So do you have enough resources available should all of your bills come due to pay them off? And so this would suggest that we'd be short 40,000. And the main driver, for the change from last year over to this year, is that we're fronting the fundraising expenses related to Holy Trinity Academy. So we know that we have to spend money to make money, but that there's a timing difference in there. So while we're incurring those fundraising expenses, we're going to see that the resources used to do that is lower until we start seeing those injections of revenue. The other thing to keep in mind is that that ARO that we just discussed really isn't something that we're going to have to pay with out of our resources. So it draws that number down, I don't want to say artificially, but it's not that we're having to use our cash dollars to pay for that liability, that there will be funding to support that. The last part of the statement is our non-financial assets and liabilities. And the first balance being our tangible capital assets, or essentially our buildings, equipment, furniture. And so when we have those larger purchases, we don't show that as an expense in the year that we make them. Otherwise, we see a lot of swings in our financial statements. So once Holy Trinity Academy comes on, we'd have a $68 million deficit for the year. And so there would be no meaning to the financial statements if we followed that type of accounting. So instead, when we purchase them, they sit as an asset on our books, and then each year, we determine how long we figure they'll be in use for. So a building could be 40 years, a truck 5 years, and then we amortize it over that useful life. So we bring a chunk of that into expense each year, and that's our amortization expense. You can see that the balance increased by $4,986,000 from last year. And the main injection, there were a couple of areas, but the main one being Holy Trinity Academy. So there was just over $6.1 million worth of work done just this year on Holy Trinity Academy. And then with some of the IMR projects, we had boilers at NDA installed at $339,000, and then a couple of roofing projects between McCoy and St. Louis for $187,000. And then offsetting that is our annual use of the assets, or our amortization expense, at a cost of $2,009,000. Below this is our prepaid expenses. So typically at the end of the year, we start preparing for the upcoming school year, and that could be the purchase of paper or paying insurance premiums ahead of time, or software contracts. And so that will live here until we're in the school year for which they relate, and then they'll become expenses. And so that balance was $1,142,000. And finally, we have our spent deferred capital contributions. So similar to the unspent line, this relates to those grants that are very targeted in nature for capital items, typically buildings. And so once we receive the funding and we've built the building or purchased the building, that funding will move up down to this line, and then it'll slowly be brought into revenue at the same rate that we have the amortization expense. So we just have this next screen that hopefully illustrates it a bit. If we were to receive $1 million capital grant, and say this is for Holy Trinity, before we started building, it was sitting in unspent deferred contributions. And then as we're incurring the costs relating to that building, it'll move down into the spent deferred contribution capital line. So we'll see that line increase, as well as our tangible capital asset line will increase by $1 million. And then because buildings usually have a useful life of 40 years, each year will bring $25,000 worth of revenue in and $25,000 worth of expense. And there won't be those massive swings on the financial statements because of the year that we receive the revenue versus the year that we purchased the building. At the end of the 40 years, we'll then have nothing in that spent deferred capital contribution line, and the tangible capital asset will have a value of $0. And finally, on this last part, we have our net assets at $2,836,000. We're going to park that figure for just a moment. There is a schedule that goes into greater detail, and we'll get to that shortly. So when we look at this statement as a whole, there's a few ratios that we can look at in terms of financial health. the first being the working capital per student. So if we think back to that negative $40,000, where we've used all of the resources we have to pay off all the debt, and then spread that over enrollment, it would come to a negative $15 per student. And we can see that that value has been slowly decreasing over the years, which is consistent with the messaging that Alberta Ed has been giving about we're drawing down reserves and whatnot. And so we can see that not only us, but also divisions across the province and those that are comparable in size to us have also been slowly decreasing, having a smaller working capital balance per student. It's also a function of enrollment too, so that value would change as enrollment would fluctuate too. This is another way of looking at it. It takes assets and divides it by our liabilities. It's known as liquidity, and so typically you'd want a value of 1.0 higher, and we're just below that at 0.99. So having that value be below 1 just means that we're not quite as flexible as we could be in terms of new initiatives and funding them and whatnot. So looking at our capital assets, quite often you'll want to look at our net book value and compare it to the original cost of the building, as that gives a sense of where we're at in terms of amortization and how old the buildings are. So we can see that we've slowly been in a decrease mode, as there hasn't been any huge injections. Once Holy Trinity is brought into inventory and we're using the school, we'll see a rather large injection into this ratio, as essentially the value of Holy Trinity is the same value as all of the other buildings that we currently have on our asset listing. So we're going to see a huge spike in this. But as we know that there's plenty of school builds going on across the province, so other school divisions will have the same situation. However, I don't know how much of an impact it will have just considering the size of our inventory. So we have 9 buildings, so adding another one will have a huge impact to this ratio, whereas if you're Calgary Board of Education, it would have less of an impact. And finally, this is the same ratio, but looking at it for equipment and vehicles. We can see last year when we purchased the fleet for the maintenance department, we had that little bit of a spike or an increase in our ratio, but it is also, as we amortize our equipment and vehicles, it will slowly decrease, and which is similar to the rest of the province as well. Our statement of operations is on page 5. And this is typically known as an income statement. And so with the 3 columns there, we would have our budget column being the first. And this is the budget that was first adopted back in May of 2024. And so just to reflect on what the key points of that budget. So we had adjusted accumulated surplus of $1,221,000, and that doesn't include our SGS funds. Enrollment was estimated at 2,785. So if you recall, back in January, we would have provided Alberta Ed with numbers that we expected our enrollment to be 2,720. And then as the schools were receiving registrations and more information was gained, we thought that the enrollment would be a bit higher at 2,785. Staffing was estimated at 151.7 FTE for teaching staff, and then non-certificated staff, aka learning assistants, secretaries, custodians, people within this building, was at 142.3 FTE, which meant that the spring budget was prepared and approved with a deficit of $437,000. But of course, right after setting the budget, there's always new information that comes along, and the first being our enrollment. So at September 30th, our actual enrollment was 2,720 FTE, which meant what we had been funded at was different by 6 FTE. So we were actually lower, but based on the composition of that enrollment, that meant that our funding increased by $224,000. There's also other changes that occurred throughout the year, some of them based on new grants being announced and others just on the accounting treatment of them. And so the new grants that were announced back in July of 2024, there was $280,000 worth of uplift on our grants that were announced. And then also with this being the first year of our summer school courses, the way that we had estimated the funding for our summer schooling, based on the funding manual, it was slightly different, but it meant that we saw an additional revenue of $107,800. So the accounting treatment though of our grants like I said, those that are earmarked specifically for specific expenses, so like our IMR, curriculum, etc., that caused a decrease in revenue of $212,000. But we'll also see that same decrease will apply to our expenses. So moving on, we can see that our budgeted revenue was $39,348,000, which was, but it came in higher by $47,700 at the end of the year. At third quarter, we expected our revenue to be $39,746,000, and so we actually came in lower by about $350,000. And so the main areas that we saw those variances, it's actually spread across all of the departments. It's never just one department that has the decrease. But we can see that we have the funding increase relating to that summer school courses of $107,800. But then fees, so this is extracurricular fees from sports, our school option fees, academy fees, there was an increase of $22,000. Other sales and services, so this is our OSC, or out of school care fees, the amounts charged for graduation, tournaments, music productions, there was an increase of $52,000. And with fundraising, there was $32,000 more, and that's at the school level. Funding that decreased were the donations that we were hoping for with Holy Trinity, and that was less by about $300,000, and then from other school authorities by $43,600. And then just those areas that relate to the accounting treatment. So IMR, there's two ways to spend IMR. If it's on the daily or like the annual maintenance of our buildings, that would be expense, but when it's on those larger changes, that becomes capital. And so it's our IMR revenue is always equal to the amount that we've expensed. We had fewer projects that we expensed last year, so that meant that both our revenues and expenses were lower by $251,000. The revenue that we bring off those capital grants annually, just like our amortization expense, that increased by $28,900. And then with the mental health in schools grant, there was an increase in those expenses by $25,600, so that meant that we also had an increase in revenue. We also had received $50,000 in strategic planning, and that relates to the value scoping audit that we're doing, but because those expenses didn't come through until the start of this school year, we didn't have the revenue nor the expense on our statements. So last thing to draw your attention to with the revenue is that with our previous discussion about the ASFF fund, because we receive that money directly from the municipalities, we have to report as property tax revenue and not Government of Alberta revenue. So even though the total grants that we received through Alberta Ed are $35,084,000, is split between those two lines. So if we were a public school division, you would see all of our $35 million on that top line, but because we receive some of that funding directly through the municipalities, we split it between the two. When we look at our sources of revenue, as one would expect, about 86% of our revenue comes from Alberta Education and Childcare, when combined with that property tax amount. And the key thing to just note here is that Alberta Education and Alberta Childcare are combined, and so now we'll see them as one line. There's not much change this year in terms of how we see our funding coming through, but for this current school year, with the licensing of our preschools, we're going to see that the amount of revenue that we would have received through that childcare line will be higher, and so it will now fall under this one area of Alberta Ed and Childcare. The other areas of revenue collection were fees. So again, that's like our academy fees, extracurricular fees, etc. And then other encompasses our international ed program, school care program, the fees from ELP, etc. Finally, the bottom part relates to expenses. And you can see here that instruction is again split between our littlest learners in ECS and those that between grades 1 and 12. We had budgeted expenses at $39,786,000, but we actually came in lower by $30,000 at $39,756,000. At third quarter, we had expected to actually have $40,114,000 in expenses, which not dissimilar to our revenue was $358,000 less, which meant that we would have a deficit of $360,000. So previously in the budget, we thought we would have a deficit of $437,000, Then at Q3, it was expected to be $367,000, and we improved upon that by $7,000 to come in at $360,000. The main variances between what was shown at third quarter and what transpired at year end, again, isn't just tied to one budget center, but is a mixture of increases and decreases amongst several different budgets. So with the instruction program, expenses were $33,600 higher than expected. The schools are provided allocations from our grants that we received from Alberta Ed, and within those allocations that they had, we thought that their expenditures would have been $163,000 higher, but they came in less, so there was a surplus there. And then on their SGF side, those expenses exceeded our projection by $220,000. And so the SGF expenses would include things for like their extracurricular sports, fundraising, and whatnot. Within plant operations and maintenance, expenses were $411,000 less than expected. As we mentioned previously, we received that grant for $50,000 for strategic planning, and because of the scoping expenses didn't come in until the fall, they're not reflected here, and that's a decrease of $50,000. Utilities were $104,000 less than projected, so this is a combination of the building management systems that we've implemented, as well as just environmental factors. Repairs and maintenance were $20,000 higher than projected. We had some staffing changes within the department, and so when we're short-staffed within the maintenance department, they'll rely more on contracted services. Within the school consolidation project or the fundraising area, expenses were $77,000 less than projected. $35,000 is related to consumables, so there were supplies budgeted for $35,000 that weren't utilized, and then there was $34,000 due to accounting treatment of capital asset. Also within that budget, our IMR expenses were $251,000 less. So as previously noted, we can either expense or capitalize items depending on their nature. And so because we had fewer of those expensing projects, it shows up as a decrease in expenses there. And then $40,000 less in amortization, or sorry, more in amortization. Within the transportation department, expenses were $61,000 lower than expected. The main driver of that was that we had intended to purchase GPS and camera units, and those occurred first thing this fall. And so because they weren't included in the last fiscal year, there's no amortization expense to record then, so there was savings. And then finally, within administration, expenses were $68,000 more than expected. So legal expenses were $55,000 higher than expected, and travel and PD expenses were $5,500 more than projected. When we look at where we were spending our money, as one would expect, 3/4 of our budget is spent in the classroom. 13% is on just our buildings, so making sure that the lights are on, that they're heated, cleaned, etc. 5.6% is to get the students to school. 4.5% is on administration, so making sure that we hire the right staff, that they're able to get paid, that our bills are paid on time. And then external services, 2.2%. And so that encompasses our out-of-school care programs and our ELP. And then if we look at what we spent our money on, again, just about 3/4 of our budget is on human capital, with half of it being on teachers, and then almost 1/4 of it being on support staff. So again, learning assistant secretaries, custodial, etc. Services, contracts, and supplies is 22%, and then that daily use of our buildings and equipment that were amortization expense is about 5% of our budget. So when we look at that, we had an ending deficit of $360,000. Schedule 3 on page 13 outlines how that deficit came to be. Again, it's never just one department. We've got 6 silos in which it relates to. And so the first area is instruction, and $358,000 of the surplus resides, or they had a surplus of $358,000. So that came to be those school budgets where they're provided allocations from the Alberta Ed grants. They had a surplus of $75,000, whereas with their SGF accounts, so those being the extracurricular activities and that, there was a surplus of $183,000. Within learning services, for the budget related to K-12 support, it was $161,000 surplus. Oh, sorry. And then PUF, so for our littlest ones, had a deficit of $80,400. And base grant early ed had a surplus of $94,200. Within operations and maintenance, there was a deficit of $502,000. And so the budget, we knew that we needed to be subsidizing the operations and maintenance budget. And at third quarter, that was at $407,000. And then with amortization expense of $105,000, that brought it to $502,000. Transportation was budgeted to also have a deficit of $413,000, but because we didn't have the GPS and the camera units installed last year, so we didn't have the amortization expense, there was a small amount of savings. And so that deficit came in at $375,000. And then system administration had a surplus of $7,500, and external services, a surplus of $152,000. So $110,000 of that relates to the out of school care program, and $1,800 relates to ELP. The last schedule that I want to draw your attention to is Schedule 1, and this relates to our net assets. So if you recall back on our statement of financial position, we had that rather large number of $2,800,000 for our accumulated surplus. And if you look at the third column in Schedule 1, the blue area, that's our $2,800,000 there, and it's actually the composition of the balance, or the balances to the right of it that make up that figure. So the first number being our investment in tangible capital assets. So there are grants, like I said, that usually support the purchase of a building, but typically we have to find funds internally in order to purchase equipment, furniture, and vehicles. And so that's the balance here. So whenever we purchase those assets, we make sure that we have enough funds set aside to cover the annual use or the amortization of them. And so we restrict it over into this investment in tangible capital assets. This past year, we had a couple of injections into it from the IT department for their uninterrupted power supply and monitors. Notre Dame also had a revamp on their fitness room, and then there were a couple of sweepers purchased for custodians. And then that's offset by the amortization expense. Our unrestricted surplus is like our checking account. It's the fund that we have available that we haven't really earmarked for anything, but we have funds there. And that's $442,000. And then we have our internal restricted balances, the first being operating at $1,142,000, and the other being capital for $728,000. And that's really just like our savings account. So money that you earmarked for a very specific purpose. And often you'll hear that we talk about our accumulated surplus. And so it's really just the combination of our checking account and then the operating side of our savings account. And that totals $1,585,000. But typically Alberta Ed wants us to reduce that by our SGF when they're talking about it. So once we do that, it becomes an adjusted ASO of $863,000. So when we reflect back on what we had budgeted for reserves, within the budget, we thought that we would use $180,000 of the operating reserve, and that we'd be moving $498,000 from capital over into operating, and having $1,471,000 left for 25-26. And at third quarter, we had updated that figure so that it would show our reserves would be at $1,813,000. And so both of those figures do actually include our SGF. So when we compare that back to where we landed at the $1,535,000, there's a difference of $300,000 there. If we looked at page 2 of that Schedule 1, it shows what we have our funds saved or set aside for. And so the first column there is our school and instruction. And the balance there is $1,360,000. And that's comprised mainly of our surpluses within schools. So they're given that allocation from the Alberta Ed grants. And so over the years, they've accumulated a surplus of $603,000. And then on the SGF side, it's at $721,000. On the capital side, there's $91,000 in capital reserves, and that relates to the modular that we have for childcare purposes over on St. Mary's site. We know that in the future, there will likely be a roof that needs to be replaced, and so we're just setting funds aside to be able to deal with that. On operations and maintenance, we actually have a restricted deficit of $350,000, and that represents the residual fundraising costs that we have with the Holy Trinity Academy project. So we know that we're hoping to recover those costs through the fundraising efforts, and so that will be able to clear out and make our net assets full again. And then we also have the $637,000 in capital reserves sitting there, and that's from the sale of the former St. Louis school. And finally, system administration has a surplus of $98,000. There are also a few ratios or graphs that Alberta Ed likes to look at here. The first being the trend of our revenues, expenses, and surpluses. So revenues are always fluctuating due to like either enrollment or new grants being announced. Expenses typically fluctuate because of staffing. And then the surplus and deficit is just a follow of that. But you'll notice that our surplus or deficit hasn't changed from either a negative 1.4% or a 2.44% of revenue. So there isn't those massive swings. When we look at our AOS as compared to expenditures, we can see that our current year value is 2.17%. And Alberta Ed just recommends that we have a value that is between 1% and 4%. So you can see that we're right in there. It has, again, been slowly decreasing with Alberta Ed's push to be using reserves and whatnot. So it's consistent with the rest of the province, as we can see. And that's it. Are there any questions related to that?
Through the chair to Dwayne. We had a lot of numbers, Dwayne, and our checking account, savings account is a big part of that. So as the superintendent, you're comfortable with where we are as a division in terms of the amount of money we have in checking account for things that hit us out of the blue and things we already have we're saving for. Are you comfortable with that? As we said.
I think for the most part, sorry, to the chair, to trustee Hellman, I think for the most part, yes, I still would like to have our unrestricted reserves a little bit higher, just saying 400,000 right at the maximum. I think it's going to take us about 7, is it right? Yeah, 700,000, just because, well, for a number of reasons. One of the most prevalent ones, I think, is our staff continues to get younger and younger. We have a number of mat leaves that come up, and we need to have reserves. You know, we don't always know about that during budgeting season, that who may be taking off on mat leave and taking some time, as well as unexpected expenses. And when you look at a budget the size of ours, $700,000 really isn't a lot of extra money that's made available to us. The second part, and it's something that we'll be talking about in schools, is just the reserves at the school level as well, because those amounts continue to grow. And so at some point, we either have to have a plan for them or we have to make a plan for them, because within education, resources are tight at the best of times. So if there's money sitting that's unallocated, then there should be a reason for that. Otherwise, we need to find a purpose for that.
Any questions, comments? Mark, I just like.
I would just, sorry, Chair.
Go ahead.
Just as a personal note, having sat through the audit committee with our financial services team and listening to the feedback from Myers Norris Penny, we once again received a clean audit, which, having worked in a number of divisions, isn't always that common, with having essentially no recommendations for improvement and so on. That means that our financial services team is doing an exceptional job with our finances in the jurisdiction. And I know Trustee Mastel and yourself are there as well have heard this information. So just a special recognition to Greg, Amanda, and their team for that hard work, because it is very common to have a list of recommendations come out from an auditor after a yearly audit, and we never have any. So
That's just what I was going to say.
sorry to steal your thunder.
That's okay. Thank you, Amanda and Greg, for all your work and your team and everything that goes into it.
And I think we do owe Amanda some additional recognition for the amount of work that goes into preparing these financial statements. They are complicated documents, but Amanda does a fabulous job of preparing them and getting them digested for us. I've talked about this before, back in 1994, when divisions were amalgamated, there were financial statements prepared, and at one point in time, I had to go back and look to see what the original assets were for the division, and the financial statements at that point in time were like 5 pages long, maybe 6, and we're up to 48, 49 pages. So the amount of information that the public is receiving, that the ministry requires, even under this version of PSAS reporting, is phenomenal, and Amanda, you do a fabulous job of doing this, so thank you very much.
Okay, any other comments, questions?
The recommended motion for the trustees is be it resolved that the Board of Trustees for the Medicine Hat Catholic Board of Education approve the 2024-25 audited financial statements and notes to the financial statements, along with the transfers to reserves as presented.
Can someone move that? Mr. Hellman? Any questions or discussion? Okay, I'll call the question. All in favor? Passed.
Thank you.
All right, thank you. Mr. West, you're up for the closing prayer.
In the Father, the Son, and the Holy Spirit. Amen. Carrying out your ministry. Lord, thank you for being with us during this meeting and for having guided our thoughts, words, and actions. Stay with us now as we leave this meeting and return to our respective lives. Help us to keep you as you are now in our thoughts, words, and actions. We ask this in Jesus' name. Amen.
Thank you. This meeting is adjourned.
You didn't get to ask your questions.
And I did appreciate